If you could own a tiny piece of the 500 biggest companies in America, Apple, Microsoft, Nvidia, Amazon, Google, all with a single click, no picking stocks, no guessing which company will be the next big winner, no spending hours reading financial reports. Just one purchase and you instantly own a slice of the entire American economy. That might sound too simple to be true, but millions of investors do exactly this every day. The tool they use is called an ETF, and the most popular one in the world goes by three letters: VOO. Whether you've never invested a dollar in your life, or you've been hearing about the stock market and don't know where to start, this is probably the single most important investment to understand. Welcome to What the Asset, where we break down everything you need to know about financial assets, from crypto and stocks to bonds and ETFs. We cover it all. If you like this kind of content, don't forget to subscribe to our channel. Let's start super simple. VOO stands for the Vanguard S&P 500 ETF. An ETF is an exchange-traded fund. Think of it as a basket that holds many different stocks, and you can buy or sell that entire basket on the stock market just like a single share. The S&P 500 is an index, a list of the 500 largest publicly traded companies in the United States, ranked by their total value. So when you buy one share of VOO, you're not betting on one company. You're buying a tiny piece of all 500 at once. VOO was launched on September 7, 2010, by Vanguard, a company founded by a man named John Bogle, who believed that most people shouldn't try to pick stocks. His idea was revolutionary. Instead of paying expensive fund managers to guess which stocks will go up, just buy all of them and let the overall economy do the work. Here's how it actually works. When you buy a share of VOO, your money gets spread across all 500 companies in the S&P 500, but not equally. Bigger companies get a bigger share of your money. This is called market cap weighting. Right now, the top 10 holdings in VOO make up about 36% of the entire fund. That means companies like Nvidia, Apple, and Microsoft each get around 5 to 7% of your investment, while a smaller company in the index might only get a fraction of a percent. VOO currently holds about 518 stocks total and has over $1.5 trillion in assets under management, making it the largest ETF in the entire world. On top of that, VOO pays dividends every 3 months. That means the companies inside the fund share their profits with you just for holding the investment. What makes VOO special is its cost. You pay something called an expense ratio. That's the annual fee the fund charges for managing your money. VOO's expense ratio is just 0.03%. That means for every $10,000 you invest, you pay just $3 per year in fees. Compare that to the average actively managed fund, which charges around 1%. That's $100 on the same investment. Over decades, that difference adds up to tens of thousands of dollars. The other two big S&P 500 ETFs are SPY and IVV. SPY was the original, launched in 1993, and charges 0.09%. IVV from BlackRock matches VOO at 0.03%. For long-term investors, VOO and IVV are essentially identical in cost. SPY is more popular with day traders because it has higher trading volume. But for buy and hold investors, VOO is usually the go-to choice. You might be wondering, does this actually work? The historical numbers speak for themselves. The S&P 500 has returned an average of roughly 10% per year over the last several decades. That's before adjusting for inflation. After inflation, it's closer to 7%. VOO specifically has returned about 13.9% annually since it launched in 2010, which translates to roughly 281% total. In simple terms, if you had invested $10,000 in VOO when it launched, that money would have grown to about $38,000 today, without you doing anything except holding it. Even Warren Buffett, one of the most successful investors in history, has said publicly that most people should just put their money in a low-cost S&P 500 index fund. In his 2013 letter to shareholders, he wrote, "Put 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's." Let's quickly cover risk in plain English. VOO only holds US stocks, so you're not diversified internationally. If the American economy struggles while other countries thrive, you'd miss out on those gains. That's why some investors also hold VTI, the Vanguard Total Stock Market ETF, which includes about 3,600 stocks, including smaller companies, or VXUS for international exposure. There's also concentration risk. The top 10 companies currently make up about 36 to 40% of VOO, which is historically high. If big tech stumbles, VOO will feel it. And of course, the stock market does crash. It dropped 34% in 2020 and 57% during the 2008 financial crisis. But every single time, it has recovered and gone on to reach new highs. The key is patience and not selling in a panic. What's next for VOO? 3 things to keep in mind. First, the S&P 500 index gets updated regularly. Companies that shrink get removed and fast-growing companies get added, so VOO stays current automatically. Second, Vanguard continues to push fees as low as possible, making investing cheaper for everyone. Third, more and more young investors are starting with VOO as their first investment, which means demand for simple, low-cost index funds keeps growing. Where can you buy VOO? It's available commission-free on most major brokerages, including Vanguard, Fidelity, Schwab, and Robinhood. If you're in Europe, you might not be able to buy VOO directly due to regulations. Look for VUSA or VUAA instead, which are the European equivalents. The exchange we personally use to buy VOO is linked in the description down below. To wrap up, VOO makes investing feel like it should. Simple, low cost, and accessible to everyone. Instead of guessing which stocks will win, you own the entire market, 500 of America's biggest companies in one purchase. With a fee of just 0.03%, quarterly dividends, and decades of proven returns, it's no wonder VOO became the largest ETF in the world. Even Warren Buffett says this is how most people should invest. If you found this helpful, give the video a like and subscribe to What the Asset for more clear, beginner-friendly deep dives. Thanks for watching, and see you in the next one.